massive drawdown in the markets driven by risk in China, driven by cryptocurrency collapse, and of course the inflation and the interest rate environment in the United States. At Orange Capital Partners, we have to reduce our leverage. I've said many times that our main goal, our purpose is to generate wealth by investing in fundamentally new concepts and engineering practices with large impact. To do that is to stay alive, which means we can't afford to have a situation where we get margin calls or we, for some reason, don't have control over our assets, and leverage can cause that. And the situation right now in the market is such that the market is completely detached from fundamentals in a sense, not necessarily in a sense, let's say, in a weighing machine sense. So there's a good reason why Netflix is down. There's a good reason why Ford and GM are down. There's a good reason why, let's say, Tesla is outperforming Netflix or Ford. These things are still intact. The relative valuation of stocks is still fine in terms of driven by fundamentals. But there is this risk in the market that just irrational things happen because of liquidation, because of stuff that just is not under control of anybody at this point. And therefore, we decided, Orange Capital Partners, to reduce our leverage. We are going from 28% down to 13% leverage, which means we're cutting our leverage in half. Unfortunately, we're down 41.6% for the year, which is, needless to say, a terrible performance. And to have to sell at this point is absolutely terrible. But it's necessary. That's the purpose of this podcast, is to give people a sense of what it feels like to run a hedge fund, have your leverage under control, and act when it's necessary. And this is one of those times. This is Not Even Wrong podcast. It's May 12, 2022. This is Crimdelco. Since the last update, we're down 12.6%. The market is down 4.6%. For the year, we're down 41.6%. The market is down 18.5%. We're underperforming by 23.1%. The major risk in the market is China. China has locked down its economy because of COVID-0 policy. That is causing massive havoc in the economy. It is causing a massive recession just by sheer definition. You don't have production, you don't have demand, you have nothing. And that is causing turmoil, amongst other things, turmoil in the cryptocurrency markets. In particular, we have the blow up of the UST stablecoin, so-called stablecoin, and we have issues with Coinbase, issues that are either serious or not serious. It's hard to say at this point, and this is part of the reason why it's so scary. But I think in general, think about it this way. Why are cryptocurrencies collapsing? Well, people were funding a lot of assets, a lot of purchases of assets in US dollars, and they are using leverage to do that, and now they're being basically held accountable for that, and the vacuum cleaner is sucking all these dollars out of the system. It's partly because the Fed is raising rates, it's partly because liquidity is drying out. No matter what it is, it's a tough decision. We believe that this UST collapse is a little bit like when Iceland went bankrupt in the sort of prelude to the 2008 crisis. So there's a good chance that we have further crisis, further turmoil down the road, and therefore we have to reduce our leverage, and we're going to do that in the next couple of days. Having said that, again, the risks in the market are China. I would say crypto is the canary in the coal mine. It's not the problem. The problem is the general idea of investors that they fund themselves in dollars to invest in assets. The reason they fund themselves in dollars is because the dollar is the most liquid asset, because it's available, and interest rates were low, and all of that is now going away. And you have this massive unwind of a carry trade. You fund dollars to buy crypto, you fund dollars to buy real estate, you fund dollars to buy equities. The same with us. We have to take the pain exactly like everybody else and unwind that leverage. And this is the fundamental reason why we have a massive turmoil in the market. On top of all of that, we also have the risk of Elon Musk borrowing shares and money against against Tesla for Twitter. And that in itself is a very bad situation for us Tesla shareholders, because we believe what Musk is buying is way, way overvalued, and it's just not good. Even if it's 20, 30 billion too much, that's 20, 30 billion out of Tesla shares, out of Tesla's market cap, out of his shares. It can cause havoc in the market. It already has caused havoc in the market. Unfortunately, we're exposed to that. We've spoken about the Twitter acquisition in several instances before. It is maybe laudable, maybe there are some ideas, but overall, it's a bad situation for us investors. It's a bad situation for Elon Musk. We hope the deal breaks or at least gets repriced. But that's another risk that we have to take into account. So what are the positives in this whole thing? The positives in the whole thing is just unfortunately, I don't have more to say than the typical long-term view, positive innovation. The stronger gets stronger in turmoils like this. The fat is being cut out of the market. So a lot of things are good. And again, in the meantime, we at Orange Capital Partners have to assure that we can survive. This is the most important thing. And therefore, we have to reduce our leverage. We have fundamentals of Tesla have never been as good as they are right now. We have massive demand for EVs. We have advanced technology that allows Tesla to gain market share or at least keep all the competitors at bay. We have a massive push to decarbonization of the economy, which is of course driving a lot of demand for Tesla's products, cars, batteries, solar. So the fundamentals are good. The risk with the fundamentals is, of course, they can't produce whatever the demand is. And Musk said that in a recent interview with the Financial Times. He didn't say we will do well. He said we can sell everything we can produce, which is a very finely grained wording, which just means, look, we don't know how much we can produce. And given what's happening in China, maybe they will be constrained by production much more than we think. Now, fortunately, Berlin and Austin are opening up, so that's a good thing. And we hope that we can compensate some of the China problems. Nevertheless, having said all of that, fundamentally, the company is in very strong position. The distraction of Twitter is a negative, and all the macro stuff is a negative. But we have fundamentally a much better situation with Tesla than, let's say, 2 years ago. And I think that's part of the reason why at Orange Capital Partners we missed on the short side of things. Because when you look at it's like that in life. If you focus on the positive stuff, you don't see the negative stuff. The same way, if you focus on the negative stuff, you don't see the positive stuff. Now, we chose to be positive, and unfortunately, we missed out on shorting, let's say, all the COVID stocks, the Zooms and the Netflixes and the Amazons and Shopifys of this world, because we were always under the impression that this COVID lockdowns and the sort of consumption that came out of the money printing, all of that was not sustainable. And this is now showing. However, we didn't think about shorting because we were just so convinced that the fundamentals of our portfolio companies are strong, and therefore we just didn't have the mental capacity to short or be negative on the market. Just to give you an example, when we were in Salt Lake City over Christmas and New Year's, my partner Zovinar, she's very good at that. She had the first signals of a recession. She saw it particularly in the online trade. And we didn't short Shopify, we didn't short Netflix. We should have shorted, of course, all these things. They're down between 60 and 80% for the year. This would have been a big money maker for us, but we didn't. And that's a big negative that we have to live with at Orange Capital Partners. It's a mistake. It's just a mistake. And the only explanation is that we were geared towards the positive, and that's fine. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. If you want to be on both sides of the trade, if you want to be long and short things, you really have to make that mental balance act between being negative and positive all the time. And that's something we can't do at Orange Capital. We tried to do it, we couldn't. It is difficult to be negative and positive at the same time. And it's almost diversifying your mental state, which is dangerous. So we chose to be positive. We're going to ride this through. We're going to come out much stronger on the other side with our disruptive technologies that we believe are going to change the world, in particular what Tesla is doing. We believe crypto is here to stay, even though a lot of shenanigans happen, like this UST BS, excuse my French. These things happen. You can't blame the dollar for Bernie Madoff. It's a little bit like that. What's happening with Coinbase is, I would say, it's embarrassing that a company that was funded by blue chip VC companies on Sand Hill Road is all of a sudden saying things like, we're not sure if our customer assets are actually theirs, or maybe we collateralize them against other trades and things like that. This is all terrible. And I don't care what the actual things are. I mean, we just try to understand the 10K of Coinbase, and on one hand, their balance sheet is 10, $20 billion of 10 billion of custodial assets that they supposedly have. And then somewhere else in the 10K it says that they have $250 billion worth of assets on their platform. So what is that? Now, if you really follow through, that's a broker shouldn't have any custodial assets on their balance sheet, because they are a broker. They just buy and sell stuff, and people have their money elsewhere. But if that's the case, then there shouldn't be any risk or recourse or any of that stuff. It should be all basically, a broker is just somebody with a phone or a technical connection, and you trade and pay them a commission. So why is this a hybrid? I'm not sure. It's on Coinbase. It's on the people who were pushing this. The company, the idea, all of these things are right, but the execution is flawed. The execution is flawed as much as many of those so-called unicorns that came out of Silicon Valley, Uber and Lyft and Airbnb and all of that stuff. In the end, maybe with the exception of Airbnb, the proof is in the pudding. Can you make a profit, an economic profit? Can you, and this is now getting back to old Warren Buffett and Charlie Munger, what is the cash on cash return on this business? Do you have enough leeway to make money in this business? Are you good enough? Do you have the production capacity, the sales channels, the technology? Can you make money? It's not a bean counter type question. It is a question of survival. And a lot of these companies, they can't make money because their unit costs are not okay. Uber is a case in point. To summarize, the risk right now in the market, the main risk for this massive sell-off that we have is China. Hopefully China will relax their lockdowns. Hopefully we can get back to normal production lines there. The crypto crash is something temporary that we see, driven by the UST collapse and the Coinbase fiasco, but overall crypto is still healthy. And we believe that the Russia risk, of course, is always lingering. There's a risk of nuclear war. So there's a lot of problems in the markets. But at Orange Capital Partners, the way we're going to stick through this is we're going to reduce our leverage and stick to our guns, fundamentally new concepts and engineering practices with large impact, in particular, the decarbonization of the energy and transportation sectors and the digitization of life sciences through CRISPR and synthetic biology and genomic technologies. Thank you.